Hi, good morning. It's January 23rd, and we're going to get right into it and talk about what do you do if you think that we need to deal with the Fed staying hawkish here. So last week, we saw markets react really differently to Fed folks' hawkish comments. So what do I mean by that is that the U.S. equities declined and bonds appreciated. Remember last year, we often saw equities and bonds fall together when we got hawkish comments. So this time around, we're seeing that investors are appearing to be a little bit more comfortable with the inflation peaking storyline. But I want to note that the current inflation break-even curve already assumes price stability, so it's baked in. And as investors, we should be thinking about a potential Fed policy mistake. So do we need to put a little bit of protection on for that possibility? Because investors aren't really positioned for one if you're looking at the market rip today, right? So what can you keep tabs on Longbow? That's really the question we're answering today. So first, let's say the Fed over-tightens and pressures growth too much, then equities certainly would decline, but we're probably going to get the dollar to decline with that. So a short USD position could work. Obviously, we've seen a recent weakening of the dollar, but this one could continue. So I'm going to reorganize some positions here. The long dollar is UUP. We've talked about that before. It's in the middle of the range. The short dollar ETF, in case you can't short securities or currencies, well, that one's nearing the top end of the range, right? So if we could see that hitting the bottom end, we could go long the UDN. If we saw it hitting the top end of the range, obviously you could short the UUP. That's how you could go short the dollar using ETFs if you can't do things with other individual securities. So that's one thing to think about. We also see on the top 25 today, you know, that tab that sometimes we go through, simplifies tail risk strategy ETF. It's called CYA, so it's easy to remember. And it's on the good side of the top 25 tab, meaning the highest risks to the upside. And you can see here that that has an oversold signal. The white line is below the green line. So I'm going to take it off KISS view for a second. Sorry about that. And then hit onto the CYA. And what does it look like? So it's been going down, down, down as the risk has been put on by investors. So if you're looking for some sort of tail risk strategy, and again, hard to devise something a little bit more intricate. Let's say you don't have that kind of capability with the prime broker or not. This is one security that might be able to provide it to you. I'm going to do a 1 week to make this easier. You can see it's below the bottom end of the range. If we look back here, it's bearish signal for both. So it probably means, like we can see here, realized volatility, implied volatility. What we're seeing is that people aren't really, people are thinking this thing's going down. So that's usually a good time when things might go up, right? That's one way to look at it if you're looking to put on cheaper protection. And then, you also might want to have longer duration bonds in your portfolio or an ETF like the TLT or EDV, which I put over here. They're both in the middle end of the range. So there's nothing actionable if you're looking at the trading ranges today. If you're looking just a few easy ways to maybe get some tail risk protection other than that CYA. But if we got a really challenging recession, yields will fall because people will understand that growth is getting hurt a lot. So again, if there's a Fed policy mistake and you see growth slowing a lot more than expected, you would get more leverage on those longer duration bonds, which should appreciate. So you should be looking, if you want to be, checking on this day to day, hour to hour, and I might not be talking about it every day. You could put these on your list and be watching those until they got obviously to the low end of the range or below. But we often the last few weeks have been going through different signals and how to put them together. But you also can look at it as maybe something's not continuing in the way you think, meaning, as we saw with the CYA, that it was declining and had bearish signals. But that usually means if you want to take the opposite side of that trade and it's at the low end of the range, that's a better time to enter because other people, are thinking this thing's going to keep going down. And with the VIX below 20 and the market ripping today, and we're still at the first part of earnings season, might be a good idea to think about tail risk protection. That's it for today. Send me comments or questions and we'll try to get to them. Bye-bye.